What I'd like to do for this video is go through a complete accounting cycle from recording of original journal entries, posting those to a T account, summarizing T accounts and a trial balance, recording adjusting entries, posting the adjusting entries to the trial balance, and preparing financial statements, and then finally recording closing entries, posting the closing entries, and preparing a post-closing trial balance. So this will get us through essentially the first 3 chapters, everything through the first exam, all in one big problem. The problem that is posted to Blackboard to go along with this is the Aurelius design. It's titled Video 3D. I won't read all the transactions to you. My assumption is that you will read these and have the problem with you so you can follow along with the transactions, partly to save space and time in the video and to not read everything. So I will go ahead and start recording the transactions listed above. Transaction A, issuing shares of common stock for $19,000 cash. We're going to debit cash for $19,000, and we're going to credit common stock for $19,000. Transaction B, purchased supplies on account for $5,000. Debit supplies to record the increase in the supplies account of $5,000. Because we've purchased these on account, there's no cash changing hands. Because this is an account we will have to pay at some point in the future, we call it accounts payable, not accounts receivable, and so we will credit accounts payable for $5,000. C, we provide services for cash and on account. So in this case, we have provided a total of $51,000 worth of services. Some of them we've gotten paid for, and some of them we have not yet been paid. We'll record the increase in cash with a debit of $10,000. We'll record the increase in accounts receivable with a debit of $41,000. Now, why is cash going up and why are customers owing us money? Because we have performed services for our customers. We have done our job. We have earned revenue. So I will record revenue. To record the increase in revenue, which is an income statement account and therefore an owner's equity account, we use a credit. And so we credit revenue $51,000. Journal entry D. We have paid salaries for $30,000. Because we are paying, we're told that the verb here is pay, not owe, but pay. So we have to record a decrease in cash. Why is cash going down? Because of salaries. So we have salaries expense of $30,000 debited and cash credited $30,000. Journal entry E, we purchase equipment for $24,600 cash. Equipment is an asset. We'll increase our asset with a debit. Cash is also an asset. Our cash is going down. We are giving cash to the vendor of the equipment, so our cash is decreased with a credit balance, or the credit entry, of $24,600. Journal entry F, we collected $32,700 of cash from customers on account. This is cash related to journal entry C. Remember, in journal entry C, we performed services for which we were not yet paid of $41,000. Now, in transaction F, we are receiving some of that cash. Because we are collecting cash, we're getting cash. Cash is going up. We're going to increase cash with a debit. of $32,700. Why are our customers paying us? Are they paying us for services we are providing at this very moment? No. They're paying us for services we provided in the past. So we don't have any reason to record additional revenue. We're not earning the $32,700 of revenue at this moment. We've previously earned it, and all we are doing now is collecting the cash that they already owe us. Because they no longer owe us once they've paid us, we are reducing our accounts receivable by the $32,700 they're paying us. So one asset, cash, is increasing. The other asset, accounts receivable, is decreasing. And G paid paid for $800 of the supplies purchased on account. So go back to journal entry B. We purchased supplies for $5,000 on account. We have not yet paid for any of those. Now in entry G, we are recording the payment of $800 worth of what we owe. Because we are paying off a liability, we no longer owe our vendor $800. We have to reduce our liability by $800 because the amount we owe goes down. We reduce our liability with a debit, so we debit accounts payable for $800. We also reduce cash by $800 to reflect the fact that we no longer have this $800 in cash. So what we've done so far is record the journal entries for the first original transactions. Now I would like to post those journal entries to the T accounts. Journal entry A is a debit to cash and a credit to common stock. Journal entry B is a debit to supplies and a credit to accounts payable. Journal entry C is a debit to cash for $10,000 and a debit to accounts receivable for $41,000 and a credit to revenue of $51,000. Journal entry D is a debit to salaries expense of $30,000 and a credit to cash of $30,000. Journal entry E is a debit to equipment and a credit to cash, both for $24,600. Journal entry F is a debit to cash and a credit to accounts receivable, both for $32,700. And journal entry G is a debit to accounts payable of $800 and a credit to cash for $800. So we have posted all of the transactions to our T accounts, and we can now create balances. Our debit balances and credit balances of cash give us a net $6,300 debit balance. Our debit and our credit to accounts receivable give us a net $8,300 debit balance. Supplies and equipment, we don't have to do any calculations. Accounts payable, $5,000 credit, $800 debit, gives us a $4,200 credit balance. Common stock $19,000 balance, revenue, a $51,000 credit balance, and salaries expense, a $30,000 debit balance. So we've posted the transactions, and now we have totaled them, totaled the accounts, and we can now create our unadjusted trial balance. We know it's unadjusted because we have not posted any of our adjusting journal entries. So we can pull our account balances straight off of our T accounts. Cash has a $6,300 debit balance. Accounts receivable has an $8,300 debit balance. Supplies has a $5,000 debit balance. Equipment has a $24,600 debit balance. Accounts payable has a $4,200 credit balance. Common stock has a $19,000 credit balance. Revenue has a $51,000 credit balance. And salaries expense has a $30,000 debit balance. We can total our accounts and find that our debits in fact equal our credits. Both columns total $74,200. Our next step is to record adjusting journal entries. We are given 3 adjusting journal entries. The first one is the recording of depreciation expense. Depreciation expense gets a debit. All expenses get debits to increase the account. So we increase depreciation expense $5,800. Our credit is to our contra asset account. Accumulated depreciation. Remember, the contra asset account has the purpose of reducing assets. So as our assets are depreciated, the value of total assets will decrease. Assets are normally a debit balance account. This credit will reduce our total amount of assets. So that's our first adjusting journal entry. Our second adjusting journal entry, supplies used during the year equal $1,300. Here we are not told what the ending balance needs to be, but we are rather told what the adjustment needs to be. We're told the amount actually used during the year. So we are directly given the amount of expense we need to record. If we had been told supplies on hand at the end of the year equaled $3,700, then we would know to subtract the $3,700 from the $5,000 and come up with $1,300. So we just have to look at the way the information is given to us to figure out whether we're told the adjustment, in this case, or the ending balance. So our supplies expense is a debit for the expense, and our credit to reduce our supplies asset is the same $1,300. And C, the company has used $5,500 of utilities but has not paid for any of the utilities expense. So we have in fact incurred utilities expense. So maybe we opened the mail on the last day of the month and we got our bill from our energy company. That tells us our bill is $5,500. and we plan to pay it sometime in the future, we have to record the expense. But since we have not yet paid any of it, we have a liability. We owe the utility company $5,500, but we have not yet paid it. I've called this utilities payable. It would also be perfectly acceptable to use the title accounts payable. That would be not a problem at all. So now we have our adjusting journal entries, and we have to post these to T accounts. Now for most of these adjusting journal entries, there's not already an existing T account, so there's nothing really to add to existing T accounts. So we can set up some new T accounts. However, for the supplies account, we will have to make an adjustment to an existing account. So when I set up the supplies account here, what I'm actually doing is recreating the $5,000 balance from our initial entry, journal entry B, and we'll make an adjustment to that. So our posting of adjusting journal entries works exactly like our posting of regular journal entries. The debit of depreciation expense goes to our depreciation expense account, and the credit to accumulated depreciation credits our accumulated depreciation account. Our debit to supplies expense records the use of the $1,300 of supplies, and our credit here to our supplies asset account reduces our asset account down from $5,000 by $1,300 to what the new total will be of $3,700. Utilities expense, we record our utilities expense with our usual debit to an expense account, and utilities payable, again, as I said, accounts payable would also be a perfectly acceptable account to use. So we have made adjusting journal entries, posted them to the accounts, and now what we need to do is create an adjusted trial balance. Now that we have posted our adjustments to our T accounts, we can then post those T accounts or summarize those T accounts in our trial balance. So what adjustments did we make? Well, what we have given here is our unadjusted trial balance, the space for adjusting journal entries, and an adjusted trial balance. We posted a $1,300 credit to the supplies account, which would reduce our supplies account to $3,700. We've also posted a $5,800 credit to accumulated depreciation. We've posted a $5,500 credit to utilities payable. We've also posted a $5,500 debit to utilities expense, the $1,300 debit to supplies expense, and a $5,800 debit to depreciation expense. So what we're going to then do is update our accounts to reflect any adjustments made. Cash had no adjustments made to it, as cash never will for an adjusting journal entry. Accounts receivable also had no adjustments. Supplies started at $5,000. of a debit balance. The $1,300 credit brought it down to $3,700. Equipment has a $24,600 debit balance. The adjusting journal entry put this $5,800 credit balance into accumulated depreciation, leaving its ending balance at $5,800 of a credit. Accounts payable has a $4,200 credit balance. Utilities payable has a $5,500 credit balance. Common stock was unaffected. Revenue was unaffected. Salaries expense was unaffected in our example. Utilities expense now has its $5,500 balance. Supplies expense has its $1,300 balance, and depreciation expense has its $5,800 balance. And if we total these accounts, we will see that debits still equal credits. They've both changed. They're now $85,500 instead of the $74,200. So now we have an adjusted trial balance. Again, what do we do with our adjusted trial balance? This is where we begin to create financial statements. So first we'll create our income statement. This is our income statement for the year. Ended December 31st, 2011. Income statement is our statement of operating activities, revenues, and expenses. Revenues were $51,000. We have our expenses. Salaries were $30,000. Utilities, $5,500. Supplies, $1,300. Depreciation was $5,800. Our total expenses, $42,600 for a net income of $8,400. Notice on our income statement the expenses that were recorded as adjusting journal entries are not really treated any differently from the expenses that were recorded as original transaction journal entries. Our $30,000 of salaries expense doesn't show up any differently from our adjusting journal entries. Adjusting journal entries only differ in a sense for when we post them into our accounting records, but they are all activity part of the year ended December 31st, 2011. We can also create our balance sheet. And again, balance sheets are as of a period of time, not for a year ended over a particular period of time. Cash has a $6,300 balance. Accounts receivable has an $8,300 balance. I'm just pulling these right off of our trial balance. Supplies has a $3,700 balance. Equipment has a $24,600 balance, but we have $5,800 of accumulated depreciation, so the net book value of our equipment is $18,800. So our total assets, including this $5,800 reduction because of our contra asset account, our total assets of cash, accounts receivable, supplies, and the net book value of our equipment, $37,100 of total assets. For liabilities and equity, we have accounts payable, $4,200. Utilities payable, $5,500. So our total liabilities are $9,700. Our equity, we have two types of equity accounts here. We've got our $19,000 of common stock, capital contributed by the owners to begin the business, and we have our retained earnings, earnings that were retained by the business. At the beginning of the year, they were zero. During the year, we earned net income. Excuse me. The final step, once we have created our financial statements, is to post closing journal entries and then post the closing entries to our trial balance, and then create a post-closing trial balance. The purpose of closing journal entries is to close our books for the current period. By closing our books for the current period, what we mean is we want to zero out all the balances in our temporary accounts and start them over at zero for the next year. So when this year is closed and next year begins, all of our temporary accounts start at zero. Temporary accounts are income statement accounts, and dividends. Both of those accounts track activity over a particular period of time. When that period of time, for example, a year is over, we want all of the activity for that period of time to be zeroed out, and so our next period can start over again at zero. You can think of this like a sports team. At the end of a season, its record resets to 0-0, and every year they start fresh with a 0-0 record. Similarly, all of the temporary accounts for a business start over at zero, so on January 1st of the next year, they can start counting revenue and expenses again at zero. So what we need to do is we need to clear out the balances of all of our temporary accounts. We have, in this example, temporary accounts for revenue, salaries expense, utilities expense, supplies expense, and depreciation expense. Revenue has a $51,000 credit balance, and each of our expenses has its debit balance, supplies expense has a $1,300 debit balance, and depreciation expense is a $5,800 debit balance. So these are all the balances in our temporary accounts. What we need to do is clear them out, bring these account balances down to zero, and where we are going to, in a sense, put what's currently in these accounts, we're going to put them into the retained earnings account, which is where we track the history of our earnings and any dividends that we pay. So the first thing we need to do is clear out our revenue. Revenue currently has a $51,000 credit balance, and we want it to have a zero balance after the books are closed. So we have to record a $51,000 debit to revenue. We offset that with a $51,000 credit to retained earnings. We are moving the revenue that we earned out of the revenue account and putting it into the retained earnings account. Our revenue account sits at zero, and at the beginning of next year we are ready to start accumulating revenues into that account. The next thing we need to do is clear out all of our expense accounts. Our expense accounts are 4 in total: salaries expense, utilities, supplies, and depreciation expenses. These all have debit balances, so we need to credit each of these accounts. So we're going to credit salaries expense for $30,000. We're going to credit utilities expense $5,500. We're going to credit supplies expense for $1,300, and we're going to credit depreciation expense for $5,800. The total of these expenses is the debit that we're going to put into retained earnings. The total of these expenses is $42,600, so that will be our debit. So we can put one big debit for $42,600 into retained earnings, and we'll post all these credits to our expenses. And now we have no balance in any of our temporary accounts. Revenue, salaries expense, utilities expense, supplies expense, and depreciation expense have all been cleared of their balances, so all of our income statement accounts are ready to begin accumulating expense and revenue items next year. And we have, in our retained earnings account, a net credit balance of $8,400, which is exactly what our retained earnings on our balance sheet was. We can see the effect of these things on our trial balance up at the top. We are going to post a debit of $51,000 to revenue, and we're going to post our credits to all of our expense accounts. And we are going to post both the $51,000 $51,000 credit to retained earnings and the $42,600 debit to retained earnings. None of our other balance sheet accounts are affected by the closing entries. Again, our balance sheet accounts are permanent accounts. These accounts do not reflect the accumulation of activity over a period of time, but rather they reflect the balance in an account at a particular point in time. So these are permanent, and all of these balances carry forward. Our cash doesn't disappear at the end of the year. Our customers who owe us money still owe us $8,300. They'll pay us back next year, we hope. We still have the supplies. We still have the equipment. We still have accumulated up to this point $5,800 of depreciation, but that doesn't go away for the next year. We still owe our vendors $4,200. We still owe the utility company $5,500, and our owners have still contributed $19,000 of capital. However, all of our income statement accounts now have zero balances in them, and our retained earnings account has the $8,400 balance in it. So if we look at all of our totals, we can see that our debits and our credits both total $42,900. Everything is in balance. So that is a complete summary from the original recording of journal entries through an unadjusted trial balance. Excuse me, this should have been an adjusted trial balance, not unadjusted. Through adjusting entries to an adjusted trial balance, creating financial statements, post and closing entries, and then creating a post-closing, after closing trial balance.